Okay, dear students, today we are going to start a new standard, a very short standard, and the name of this standard is IFRS 11. IFRS 11. But before we move on to IFRS 11, just a quick recap of different levels of investment. See this sketch. If you have like 50% plus shares, if you have 50% plus shares of a company, that means you have control of that company. And when you have control of a certain company, that means that company is your subsidiary and you are a parent company. And now the accounting which we are going to follow is adding together consolidation. Okay. In your basic studies, you have done consolidation. Plus, in my classes, I will also teach consolidation in very detail. Okay. The second level, the a little lower level, is significant influence. When you have, see the screen, when you have more than 20% but less than 50% share of a certain entity, that means now you can exert significant influence on that company. So now whenever you can exert significant influence in any company, that company will become your associate. And now the accounting which we are going to do is equity accounting, the one line adjustment accounting. Okay, this is also you have done in basics, plus I will teach you also in my studies with consolidation. Now there is a third level, and this is the level like this. If you have like 1% share or 2% share or 0.1% share of a certain entity, so now you have no control, no significant influence. So this is such investments are called trade investment. Such investment are called trade investment. And for trade investment, we apply IFRS 9. I hope you remember IFRS 9. And in IFRS 9, you can apply two categories on it. One is fair value through P&L and the other is fair value through OCI. That's it. Okay. So these are the different levels of investment which you have studied in your life. Now, here you will study a new level, and that is called IFRS 11 joint arrangements. Joint arrangements. I'm going soon in this class, I'm going to teach you different types of joint arrangements. But before I move on, let me tell you one thing. For joint arrangement, this thing is very important. Joint control is must. If you want to apply this standard, so joint control is must. What do you mean by joint control? Joint control means, for example, there are three investors, A, B, and C. A, B, and C. Okay. So if I say that these three have joint control, means unanimous consent of all parties. Unanimous consent of all parties. For example, if I say A, B, C, these are the three investors and they all have joint control. So in other words, I'm saying that if we want to change anything, if we want to change anything in that company, we need consent of all these three. All these three must say yes, then changes will happen. Okay. So this is what we call joint control. Joint control. Okay. Right. And I sometimes say to my whenever I give a business advice for partnership to somebody, I say to individual partners that please use these terms in your contract. For example, let us say I am a partner in a certain entity and there are other 3 4 partners as well. So in the agreement, I should write these terms. Means I would say I need joint control. Means unanimous consent is must. That means if the other partners join hands together, still they can't do anything of me, because my yes is also important. My yes is very important. Without my consent, they can't change anything. Okay. So now let's do, these were the historic past papers. It came in the history that whether in this question, these are few examples and we need to see whether in this question it is joint control or not. See now, A, B, and C are three investors holding 33% shares of this. Let us say, let me write the name of this company, Y company, just okay. this Y company. A, B, C holds 33% of Y company. Now, what the article says? The article says 2/3 majority can force any decision. Now, do you think it's a joint control? No, no more joint control. Why? Why? 2/3 means there is a possibility that sometime A and B join hands and they will kick C, because A and B means 2/3. It is possible then B and C can join hand and it will kick A, or A or C can join hand and they will kick B. So that means all three does not have joint control. All three does not have joint control means if we are saying that ABC has joint control, that means without their consent nobody can change anything. So here they can do, if two of them A or B can join hand, they can kick out C. B or C can join hand, they can kick out A. So now it will say that there is no joint control in this question. Now now this is not joint control. The solution is written here. Okay. Now example number two. A, B, and C. A, B, and C. A has 50, B has 35%, and C has 15% of the company. Now article says for any decision 75% vote is must. 75% vote is must. Now we can say A and B has joint control over this. Why? Listen. Because for any decision 75% vote is must. See, if B and C can join, if B and C join hands, 35 plus 15 is only 50. They can't do anything. Okay. If A and C, second thing, C, if A and C can join hands, then 50 plus 15 is 65. 15 plus 15, they both can't do anything. So now see, that means A and B, they have joint control, because without these two players nothing can happen. These two must say yes to change any decision, and yes, they both have joint control. And yes, it is also written in the IAS that two people must be there for, if you want to prove a joint control. So minimum two people must have in the group, minimum two people must have joint control. So here A and B has joint control. A and B has joint control. Now, this was just a starting walking of mind, or what I would say jogging of mind. Okay. Now we are going to discuss the two types of joint arrangement. The first one is joint operation. What does it mean? Joint operation means not a separate vehicle. Normally in joint operation, we don't create a separate entity. This is normal, but yes, they do sometime, but normally they don't create a separate vehicle or separate company. Assets, liabilities, income, and expenses shared by parties. Yes, for example, there are three teachers and they want to teach together. So one teacher said, I have a property empty, so I can bring my property. The other said that I have furniture, and the third guy said that I have management skills, so I will control the admin. So they all three bring their expertise, and they divided the time. Like in the morning time, one teacher will teach, evening the other teacher, and the afternoon other teacher will teach. Okay, so now that means they have brought their resources which they own personally, and now they are sharing the resources. Okay, so interest in assets and liabilities by parties. Yes, now each and every teacher, I gave you the example of teacher, each and every teacher would say that, first teacher would say that this property belongs to me, complete asset belongs to me. The other teacher would say all chairs and all furniture belongs to me, right? So now the assets belongs to direct parties. Parties will have direct interest in the asset. Okay, so this is also joint operation. Okay, right? One more example I can give you. This is very common. I think that it came in one of the past paper. Like, there is a pipeline from Turkey. Just create an example. Let us say Turkey is oil rich country. Okay, or Saudi Arabia is an oil rich country. Okay, so there is a pipeline from Saudi Arabia to India, right? One company created a pipeline, there is a pipeline. So now not a single company can buy all the oil from Saudi. It's so big, they have extreme oil. So now three companies or two companies join hand that they will distribute the rights. They will distribute the rights of this pipeline. Like in 24 hours, like 12 hours will be used by a company. Like for first 12 hours will be used by Shell, and the other 12 hours will be used by other companies. So now they directly own the rights in the pipeline. Okay, they directly own the asset, we can say, right? And they have distributed the timing. So this is also joint operation. Now what is the treatment? How to record in each and every book? Record your share of asset, liability, income and expenses in your books. What does it mean? For example, this is oil pipeline. This is oil pipeline, and this costs $10 million. The cost of this oil pipeline is $10 million, and A and B owns 40-60. A owns 40% and B owns 60%. So like this pipeline is a non-current asset and it's a PPE. This pipeline is a non-current asset and it's a PPE. So now A and B will directly record in their books as a PPE, property, plant and equipment, and 40% is owned by A and 60% is owned by B. So 10 million multiplied by 40%, 4 million pipeline will be recorded as a PPE in the books of A, and 10 million multiplied by 60%, that means 6 million PPE will be recorded by B. So directly they will record assets. Directly they will record assets, liabilities, income and expenses. Same is the case. For example, they share the pipeline, and now through this pipeline, a company earned a revenue. A company earned a revenue of $20 million. So A company will directly report in their sales directly in their sales. Okay. And B company will report their sales directly, whatever they have earned. So what does it mean? See, record your share of asset, liability, income and expense in your books. Okay, so no other accounting, directly you will record. If you have share in intangible asset, record it in your intangible asset. If you have share in PPE, record in your PPE. So everything you can record directly. Okay, so the first thing is joint operation. The second thing is joint venture. What is joint venture? Now joint venture is like a formation of a separate entity, separate vehicle. See, separate vehicle, like it's a separate limited company. We incorporate a separate limited company, and all the investors distributed the shares. The investors A, B, C distributed the shares. Okay, and whenever we distribute a shares, whenever shares are distributed between parties, ordinary shares, I would say ordinary shares, then we can say the interest of parties in net assets. This is very important. Take one example. Listen. For example, I have 10% shares of Unilever. I have 10% ordinary shares of Unilever. Okay. So now I cannot do this thing. Listen to me. Listen to the story. I cannot go to the Unilever building and I say this building belongs to me. No. The gatekeeper will say bye. Go out. I cannot say that these shares belongs to me. Although I am a 10% ordinary shareholder of Unilever. But I cannot say like this, that this building belongs to me, these cars belongs to me. No, because I don't have any interest in the assets. I have interest in the net assets, equity. Whenever you became a shareholder, you always have an interest in the equity. Don't forget. It's like investment in shares. Same. One more example. I cannot say that Unilever revenue belongs to me. 10% of the Unilever revenue belongs to me. No. I cannot say 10% cost belongs to me. No. I have only rights in the profit after tax. the profit after tax is distributed. The profit after tax is distributed between shareholders in the form of dividends. Okay. So in joint venture is a separate vehicle in which the parties distributed shares, ordinary shares. That's why the parties have interest in net assets. Here, interest in assets directly. See, interest in assets. Here, this is the biggest difference. Interest of parties in net assets. Okay. It's like investment in shares. It's like investment in shares. Now, what is the treatment for joint venture? Equity accounting like associates. Remember equity accounting. So if I have shares in joint venture, so I will treat this joint venture like my associate. Remember equity accounting, COI at post profit share of a company's post profits, you will get carrying value of investment in associate. So whatever accounting you do with associates, same accounting you will do with joint venture. Same accounting you will be doing with joint venture. Okay. So these are the two things. But yes, for these two accounting, first thing is joint arrangement. Okay. First of all, joint arrangement, and for joint arrangement, joint control is must. For joint arrangement, joint control is must. Okay. Now I'm going to discuss a small question. This question is also present in the IFRS official book, and this is also in your study text as well. Okay. Two real estate companies, two real estate companies set up a separate vehicle super mall. Okay, so first hint is for JV, joint venture. They created a separate vehicle. See, we just studied. So I will gather the evidence and I'll share the solution with you then. So the for the purpose of acquiring and operating shopping center. Okay, so they want to acquire a new shopping center, so they created a separate vehicle. The contractual arrangement between the parties establishes joint control of the activities that are conducted in the super mall. Okay, so all investors have joint control. So this is also a condition for joint arrangement. The main feature of super mall's legal form is that the entity, the newly born entity, not the parties, has right to the assets and obligations for the liabilities relating to the arrangement. Yes, all the assets, in when you guys were kids, you guys were infants, so your teacher taught you for limited company all assets belongs to company, all liabilities belongs to company. Shareholders are not the owner of the assets. Remember, shareholders only have interest in the net assets. So this line again indicates that this is a joint venture. I read again. The main feature of the supermall's legal form is that the entity, the newly born entity, not the parties, has right to the assets and obligations for the liabilities relating to the arrangement. These activities include the rental of the retail units, managing the car parking, equipment such as lifts. Yes, these are the routine work, customer base. These are the routine work for a mall management. Okay. Now, the terms of the contractual arrangement are such that Super Mall owns the shopping center. Super Mall is the new entity. Super Mall is the new entity in which we have shares. The contractual arrangement does not specify that the parties have right to the shopping center. Okay, so the parties, the investors, parties means investors. The investors have no rights directly in the assets. They have only rights in the net assets. So again, it is joint venture. Yes, for joint operation, directly involvement. The parties are not liable in respect of the debts, liabilities of the obligation. Yes, this is the concept of limited liability. Limited liability, that means a separate vehicle is there. If Supermall is unable to pay any debts or other liabilities or to discharge its obligation to third parties, the liability of each party to any third party will be limited to the unpaid amount of the party's capital contribution. Yes, shareholders are just responsible for unpaid amount of share capital, nothing else. Nothing else. Nothing else. Okay. Now read the point number C. The parties have the right to sell or pledge the interest in Supermall The parties have the right to sell or pledge their interest in supermall. That means yes, you can sell your shares. If you have shares, you can sell it. Yes. Each party receives a share. Very important. I love it. Each party receives a share of the income from operating the super center, which is the rental income net of operating costs. See, this is profit after tax. Rental income net of operating costs. That means you will get a profit after in accordance with its share in the super mall. So yes, you just own shares. You are just a shareholder. So again, this is the evidence that this is a joint venture. This is a joint venture. Otherwise, in joint operation, you get the share of revenue. You have to bear the share of cost directly in joint operation. This is joint venture. This is joint venture. See, so they are asking now. You can read this solution. You can read this solution. Okay. I think there is a new question in 2025 or 24 past papers as well for this. I have also covered in my past paper. I have a separate classes of past paper in the end of your LMS. A lot of past papers. So you can read. Supermall has been set up as a separate vehicle. See, so it could be either joint operation or joint ventures. Still, it's a hint of joint venture, but they have written joint operation. They have other factors as well. So other factors must be considered. There are no fact that suggests that two real estate companies have rights to substantially all the benefits of the assets of supermall, right? The parties does not have any rights directly in the assets. They have only rights in the net assets, nor an obligation for its liabilities. Each party's liabilities is limited to any unpaid capital contribution. Okay. As a result, each party has an interest in the net assets. Okay. And it's a joint venture, and for joint venture we do equity accounting. For joint venture we do equity accounting. Okay. Now my dear students, we are doing a past paper question, but I'm right now I have a separate past paper classes as well for you. So right now I'm just giving you a hint, just a discussion. I'm not writing anything. I'm just giving you a hint for this. Okay, just walking through this past paper, because we have separate past paper folder for you in which I have covered everything in detail. So don't worry about it. Now, Gas Nature is a publicly traded entity. Gas Nature is a publicly traded entity involved in the production and trading of natural gas and oil. Okay, so this is we produce and we trade in oil. Okay, Gas Nature jointly owns an underground storage facility. Jointly owns means directly we have rights in that asset. We directly own like 40-50% of the share of that storage facility belongs to directly rights in the assets. Direct rights in the asset means this is joint operation. This is joint operation. Whenever you have direct rights in the assets, that's joint operation. And whenever you have rights in net assets, it's joint venture. So they are saying Gas Nature jointly owns the underground storage facility with another entity. So yes, it's joint operation. Go Gas. Both parties extract gas from offshore gas field which they own and operate independently from each other. Okay, they have distributed the time. I have given this example in my lecture. Gas Nature owns 55% of the underground facility and Go Gas owns 45%. Okay. Now, they have agreed to share services and cost accordingly, with decisions regarding the storage facility requiring, see this word, unanimous. I taught you today. Unanimous agreement of the parties. Yes. So when you have unanimous consent of the parties, it's joint control. And joint control is the primary thing. Joint control is the top of the umbrella. So yes, here we have joint control, but as these two parties directly owns the asset, that means we would say this is a joint operation. And you know the accounting of joint operation. Now these two parties will directly record this storage facility as a non-current asset in their books. Like one guy owns 55%, the other one owns 45%. See the screen. One guy owns 45 and the other one owns 55. So they will directly record 45% and 55% in their own books PPE. Secondly, they share the cost accordingly, so they will directly book the share of their cost in their books. Okay, and definitely whatever they will earn, they will directly book as a revenue. Okay, so now there is no more equity accounting in this question, and it's a proper joint operation. Now listen, for you guys, the relevant part of this question is from this part. See, this to this. Okay, now we are doing something extra. Now we are coming to IS 16. Now new thing is started, that IFRS 11 is no more in this question. Just these 5-6 lines. Now the underground facility is pressurized so that the gas is pushed out when extracted. When the gas pressure is reduced to a certain level, the remaining gas is irrecoverable. And remains in the underground storage facility until it is decommissioned. Now wait. This area is IS 16. Let me tell you one special story. I think I have made a vlog on this issue. See this. Let us say this is our storage facility. Okay, so the gas is coming from this side, and let us say we are refining the gas. For example, you know the meaning of refinery. We are refining the gas, but this storage facility is designed in such a way that a minimum level, I'm using black pen, a minimum level of gas will remain. You can say gas or oil, anything you want to like say. A minimum level of gas will keep here for like 5 years. Next 5 years, this minimum level of gas is must here, and the remaining gas will come and go. But this is the minimum level of gas which we have to maintain in this box, in this storage facility. So now I agree that for such oil companies, gas is an inventory. IS2 is applied, but this compulsory gas which we have to leave for next 5-6 years, so it's performing a function, and this gas we need it for next 5 years, so it's your PPE. This gas is the part of PPE, and you have to apply IS 16 on it. You have to apply IAS 16 on it. Okay, and later on, after 5 years, when we are going to close this facility, at that time we'll dispose of this non-current asset, this gas, and any gain or loss on disposal will go in the P&L. This is a very interesting issue. Although gas is inventory for such companies, gas is IS2 inventory, but this gas we have to keep for next 5 years. So it is performing a function. Without this gas, this whole process will stop. Without these walls, these walls are also important. Without these walls, we can't do. So same is the case with this gas. Without this minimum gas, we can't run this show. So this minimum gas is performing a function. So it will be part of IS 16, property, plant and equipment. It will be classified. It will be capitalized as property, plant and equipment. So we have to report this in SOFP as PP. And yes, after 5 years, we'll sell out this gas, and whatever will be the difference will go in the P&L as a gain or loss on disposal, like simple disposal accounting, gain or loss, simple PP disposal accounting. I hope you understood it. I repeated 2 times. And yes, now you guys are no more kids. You are big boys. Now next thing. Local legislation requires the decommissioning of the storage facility at the end of its useful life. Yes, IS 37. See, till now we have covered three standards, four standard. Yes, IFRS 11, then IS 16, a little touch of IS 2, and now they are talking about IS 37. So, do you know the meaning? If you have attended my IS 37 classes, definitely. So, I have covered compulsory disposal cost, or we call it decommissioning liability. Remember, there are two names. Listen, let me remind you. This is year 0, this is year 5. Today we have taken, I am giving you the example of mining. Today we have bought the rights of a mine, and when at the time we were about to start the digging, government agencies comes to us and they gave us a piece of paper to sign. It was clearly written on that paper that whoever is going to destroy this site will compensate it at the end of year 5, will landscape it. So very next moment we are going to dig this site, and we are going to destroy whole place. So that, yes, present obligation, the obligating event is started from day 1. So now on the day 1 we have to make this entry of compulsory disposal cost using the present value of future cash flow, and the entry will be PP debit and provision credit. Remember, PP debit and provision credit. Yes, such decommissioning liabilities are capitalized as part of property, plant and equipment. Okay, so same is the case with here. That, see, local legislation means we have a legal obligation. Legislation has been passed. Local legislation requires the decommissioning of the storage facility at the end of useful life. At the end we have to decommission it. So it's a present obligation now, and we have to, as we have 50, gas nature has how much shares? 55% shares. Gas nature owns 55% of this underground facility. So 55% of the total liability, the present value of the 55% of the total liability will be booked in our books like this, okay. And yes, one extra point in exam, if you forget that point, still you will get good marks. And for the remaining 45%, although we are not directly responsible for the remaining 45%, but there is a possibility. What if in the end that other party will run away? What if in the end that other party will run away? In that case, we just have to make a contingent liability disclosure, of this 45%. Although we are not directly responsible for this 45%, okay. So I have discussed all the aspect of this. So I would request you to revise this standard, make notes of this standard, do the past papers, see 24 25 attempt questions. Okay, so in this way you will be able to do a lot of things. Okay, thank you and take care.